I'm getting ready to go on mute. Okay, 11 o'clock, take it away.
All right, well, good morning, folks, and welcome to our monthly home buying seminar, our happy hour, if you will. So whatever your favorite drink is okay with us. We have Dawn there, she's drinking her water. Actually, I'm doing the water thing too myself today. I feel a little, she got her coffee cup, yep. Sometimes, I'll be honest, I'll do the coffee with a little bit of rum chata. It's really great, so if you haven't tried that, definitely. Well, so we have a jam-packed session for you today. It's just an hour session. We want to be respectful, of everyone's time. So welcome to the McIlwain Group's home buying seminar. We do this on a monthly basis. So if you have folks who who would benefit from this home buying webinar or Zoom call, feel free to share with them next month's information, because we'll be providing that following today's session. So we'd like to kind of have some dates already set up so that you can plan accordingly and be able to join us. So with that, I want to quickly just introduce the team. We have Janell McIlwain on the line. She is our team lead for the McIlwain Group. So you see Janell over there waving. And then you'll see also Dawn Ferguson. Dawn Ferguson is also one of the awesome realtors on our team. My name is Tia Thompson. I'm also part of the McIlwain Group, and we have a few others. There's also Issa, who's awesome, who helps keep us together. We love Issa.
Good morning. Good morning.
He keeps us together.
Tries.
Tries, yeah.
I don't quite see Vonley yet, but I think she will be joining us soon. So that's pretty much the team. There's probably well over 20 years of realtor experience between all of these great folks on this team, and so excited to be a part of that team. And I definitely don't want to leave out our guest speaker today, which is Erin Johnson. Erin is a phenomenal lender. She has a lot of knowledge about the mortgage industry. She shares, every time I talk to Erin, I always learn something new. She always drops a little tidbit for me that helps me when I'm out there out in the field. So I thank you for that to Erin. Well, so with that, I'm going to turn it over to you, my friend, and the floor is all yours.
Thank you.
Yeah.
Well, I do have to say I really enjoy being here on these Saturday mornings. I love this group. You guys are a group of professionals. It makes my job easier when I feel like I'm working with team members as opposed to just the average realtor where, almost sometimes it's adversarial. But anyway, in this case, always, you guys are definitely an added part of my team as well. So thank you. So I guess we'll start with some of the questions that we've been asked, and one of the biggest things. So first and foremost, and I've had this come up this week, is that there's a difference between a pre-qualification and a pre-approval. I know that there are times you'll get on the phone with a lender, they'll ask a series of questions, they'll tell you you're pre-qualified. That is not a safe tool to begin shopping with. You always want to shoot for a pre-approval. Now, legally in all our advertisement, we always advertise pre-qualification. Our pre-qualification process, and what you want to do when you're getting pre-qualified, is make sure that the lender has your documentation, your pay stubs, your W-2s, your bank statements, anything that has to do with your financials that's going to prove that you can afford this mortgage, that's going to help us decide what program is going to best fit your needs. And that brings us to the question, how do you determine what product or loan program is actually the best for you? Now, there are many programs out there. Most first-time home buyers are looking for ways to afford the down payment and the closing costs. Interest rates right now are on a little shaky ground. So what you want to do always is focus on your payment and what you qualify for. I noticed one of the titles of our events today had to do with renting and the rent race. And quite frankly, renting doesn't really give you the benefit of building wealth throughout your lifetime. Your building somebody else's wealth. You're paying somebody else's mortgage. And right now rents are increasing. We've seen them increase just like interest rates, just like everything else out there. So focusing on actually finding a mortgage payment that you can afford, along with fitting your cash to close needs. So that's where we come in. We're going to pull your credit. Your credit is going to determine which programs you may actually qualify for. Not one program is necessarily better than the other program. That's a myth out there. Some programs are a little bit more flexible if you have job history issues, not issues, but if you've worked multiple jobs or have had a short time on your current job, you've come out of school, you're a first-time home buyer, you are going into the field that you took your degree in, you've had several jobs in between because you're working your way through college, some programs will handle that a little bit better. So our job as lenders is to look at everything about your credit package, your credit score, because that will dictate which loan program may work best for you. If your scores are really high, we'll entertain or look at conventional programs. Most likely, they will let you get in with as little as 3% down. And in some cases, you can add down payment assistance to them. FHA kind of fits a wide variety. You can have spotty credit, you can have excellent credit. What we look at there really compares the payment to the conventional side, your cash to closing or cash for closing, sorry guys, and your debt to income ratio. And if you're not familiar with a debt to income ratio is, there are two types of ratios that are used in qualification. One is your housing expense, which is your monthly payment divided by your gross monthly income. And the second is your debt to income ratio. How much debt you're carrying along with that mortgage payment divided by your gross monthly income. There's more flexibility in an FHA loan than there is in a conventional loan. So that might help us to determine which might work better for you. There's also out there USDA financing. If you're buying in an area that is designated for USDA, that's a true 100% program. They look very heavily at that housing expense ratio. And sometimes we'll talk to borrowers and say, you qualify for this much house, but we have to use this program because of these things. So that's really determining condition of the property could also be something that factors in. If you're buying, say, we just opened a manufactured home product. There are manufactured homes in our area, and for a long time, they couldn't be financed. The only program that finances them is FHA. So if that's the type of house you're interested in, that's the one we'll take you through. So we're really your guide to discuss everything that concerns you regarding this mortgage, put it into a product that best fits your needs and match you with that loan program. The best thing is, educate yourself about the loan programs, ask questions, tell us what your concerns are so that we can address them and apply them. So we're really kind of your guide with that. That's our job. Determine what loan program matches best to your needs and moves and get you into that house with the least pain as possible.
You know what, Erin, it's funny you mentioned that because I had a relative. I love the relatives. When you're in a profession, they come to you for everything when it relates to that profession. So, of course, the question was about lending, because she's the relative is working with a realtor and working with obviously a lender, and this is a really common, I think, thing that I hear from especially buyers, is they feel like there's more programs out there that I guess they feel like the lender is not either sharing with them, or they're hearing about all these other things out there and the lender hasn't talked to them about that specific program. So the best thing I told her was that, you know what, bottom line, you have to qualify for those programs. So I'm hoping that that's what's happening. I'm sure that's happening with you, with your clients, that you're just letting them know what programs they are qualified for. They may not be qualified for this program, but this one may fit your needs. So right. I think, when folks are, trying to really get that down payment together and they're trying to understand what they need to bring to the table, those lines can get a little blurry for buyers.
Absolutely. Well, and that's qualification. So when you're talking about programs specifically, most programs have basic guidelines that we have to follow that pertain to income, how much money they make, income limits. You can't make more than, and that sort of thing. So what we do when somebody comes in and talks to us, yes, we're trying to address their concerns, meet their needs. However, we may have already eliminated some of the things that don't work. So the best thing is to ask the question, what programs do I qualify for? Am I qualified for down payment assistance? If you ask that question specifically and they offer a product, they'll be able to give you that input. Now, remember that not all lenders offer all of these programs. When you're working in an area, the best thing is to work with a knowledgeable realtor, to also work with a local lender who understands the programs that are available in the area. I'm not going to go and take out a loan with somebody who works on the on the West Coast, hoping to get a Maryland mortgage program down payment assistance loan. They have no clue how to do it. Okay. Yeah. USDA, that is a foreign acronym to some lenders. Yeah, they have it. It's an obscure loan program. They've never used it. They don't understand it. They don't know the ins and outs, and they don't know that they can either include it in the programs that can be offered or exclude it based on the income limit or based on the front end ratio, the housing expense ratio, or that it can't qualify in Waldorf, right down smack in the middle of Waldorf, but it works in White Plains out towards the 210 corridor. So those things are super duper important. And those are mistakes that I've seen lenders make that I'm now talking to borrowers that have been sent to me saying, hey, we have this issue and this is why. Just the other day, some lenders just sell FHA products. Now, between you, me, and the lamppost, the other thing you want to do is make sure you're working with somebody who genuinely cares about your situation, because not all programs are treated equally in the eyes of lenders. Yield spreads and things like that, and especially as interest rates go up, more push is going to be towards one program to make more money by that lender as opposed to another. So you really want to make sure that you're feeling genuinely cared for when you're looking for these things. Definitely work with somebody who works with a team with your lender. We want to make sure these things are matched up. So those are super duper important. You guys have a great deal of knowledge of what's programs out there, enough to say you may qualify for this. You need to talk to this lender, and that stuff is very important too. So
you know what? I think part of that too, sometimes with buyers, I think they're wanting to understand if some of those programs are stackable. Do you you understand what I mean when I ask that question? So when they say that they're not feeling like they're being able to take advantage of all the programs out there, I think part of that mindset is thinking, well, do I qualify for this, and this, and can I stack it?
No,
Absolutely.
right. Well,
So,
in the case of the Maryland mortgage program, you can stack that with an FHA loan, a USDA loan, and a conventional loan. So yeah, those can be included, but you can't stack you can't take an FHA loan from one lender, go to another lender and get the down payment assistance from the MMP and put those together. You have to do it with the same lender, and you have to use an approved lender through that program. You can't stack, say, a FHA loan with a Chenoa loan, which is, by the way, another form of down payment assistance. Not my favorite because it's a little bit more expensive than the Maryland mortgage program, and I don't think it adds as much benefit, but you can do it. You can't stack those two loans together. So you can't get 5% from the Maryland mortgage program and 3% from over here. Those programs are exclusive right there. Now, in the case of an FHLB fund, FHLB is a Federal Home Loan Bank of Atlanta. When that money is available, you can stack that with a MMP loan. Unfortunately, they only renew those funds at certain points. They're not always available. One of the favorite things for lenders to do when somebody asks about a Maryland mortgage program and they really don't know about the program or they don't offer the program is to say that there's no funds available. So I met with Maryland mortgage program and they said the following: we never run out of funds, ever.
Wow.
Okay. So now they'll change their programs periodically. but they're never running out of funds. They're always going to be able to offer this. And this loan has been in existence since I started in the business, by the way, and I'm going to age myself 25 years ago, you know, walking in green and doing my thing. We offered what at that time was the CDA loan, and that loan has changed over time to be much more user friendly. They now offer 5% in down payment assistance, which if you in fact get into a situation where you're getting a little bit of closing out from the seller, that means you could get in basically with no money. That's you always have to have an earnest money deposit, and you always have to pay for your inspections, but in some cases you can get some of that money back. So the loan programs, you know, that's really, we're your shopper. We're going to go out there and find it. We're going to narrow the choices, because I don't want to offer you 5,000 different choices and have you confused about what can and cannot be done. But ask questions. That's what we're there for. That's what we want to know. You know, what is your biggest concern? Is it down payment, closing costs? What can we fit you into? And what are your concerns about this program in particular? And ask us if you are aware that there could be other programs, why you're not being offered those programs.
So Erin, there's a question posed in the chat. We wanted to know, you mentioned earlier about certain programs being a little bit expensive, but expensive in what way? Is that, do different programs vary in interest rate? And how does that typically affect the buyer at the end of the day with wanting to get help on these down payment or closing cost assistance programs, but how does that affect their loan? Can you break that down?
Yeah, so more expensive, that program in particular, the Janell program, which does serve its purpose, okay? You pay points up front, so that's going to affect cash for closing. And the interest rates are a little higher than what you'd find on a normal FHA loan or even on the Maryland Mortgage Program loan right now. So it's going to affect your monthly payment. So when we talk about rates, that impacts your payment. Points, money that you buy to buy a certain rate impacts your cash for closing. And if you're not getting any closing help, there is a difference between down payment and closing. Okay, your down payment is the money you have to put into the transaction in order to meet the loan to value, how much you're borrowing divided by how much that house is you're purchasing the house at, or how much that house is worth. So when you talk about cost, it can either be interest rate or points. It's going to affect either payment or cash for closing. Bailey, did that answer the question, Vonley?
It did. It definitely did. So I wanted to know, I guess going a little bit deeper with different programs that are available. Are those programs, like for instance, we were talking about like FHLB, MMP, things of that nature. Do those come at a different interest rate? So hypothetically, say if I'm pre-qualified or pre-approved for an amount of, let's say 430, right? But I need some assistance with my down payment or closing costs. And, you know, I come to you and I'm like, hey, Erin, so I'm really interested in this house and we know that I'm pre-approved for this much, but is there any way that I can get any help on not going broke buying this house, essentially? And you say, yeah, you know what, there's this great program that you qualify for, but I want to know that caveat. Is there a different interest rate for that program that may help me?
Yes. So the Maryland Mortgage we'll address the Maryland Mortgage Program specifically, and then just know it applies to other programs as well. And I want to talk about the FHLB just on a side note after. But when we talk about the Maryland Mortgage Program is a state-run program. They set their interest rates. There is no way to buy those rates down. They tend to be slightly higher if you're taking down payment assistance from the state of Maryland. They tend to be a little higher than the going interest rate for a straight FHA conventional or USDA loan. Okay, so for a few dollars more, now keep in mind, 1/8% in interest rate, 1/4% interest rate, even 0.5%, you're talking maybe, you know, if we break it down, $75, maybe $120, $150 more in payment to come up with 5% less down money out of pocket. Okay, so if we were to So if we look at a $300,000 sales price, and bear with me while I do my math on my calculator. Okay, you're getting, so today on a 5% down loan, I'll pull that rate up too, hold on. 5% down payment assistance through the Maryland Mortgage Program. They are offering, and I want to see, because there was a rate change on Friday for everything. 5%, you pay 6.125 on an FHA loan, where you might be paying 5.75 for a straight FHA loan with no down payment. So a slightly higher interest rate, but you're going to get $15,000 to apply towards down payment and or closing costs. Okay, so you have $15,000 now in your account, and you're paying $120 more per month. That's, you could actually take, if you had $15,000 in a savings account, you could supplement your monthly payment for 10 years. You could take $125 out, or you take $125 out of your savings account for 10 years if you felt strapped because of that $120 difference. Okay, and that $15,000 you'd be getting is interest free. So you don't pay any additional money towards it. It's money you can use for however long you have that first mortgage, that FHA loan, without paying any interest. It never accrues interest. So you always just owe $15,000, and it just sits out there. And if you sell or refinance the property, you have to pay it back, but it sits out there. So you're essentially financing 100% of that loan, but that $15,000 doesn't accrue interest. Does that make sense?
Mm-hmm.
So it's free money. Yes, it has to be paid back, but it's free.
Yeah.
It's free, you know? So it's there. So yes, they come with slightly higher interest rates, and yes, that will impact your payment slightly. But when you look at the big picture, it's easier to stomach when you break it down and look at what you could save.
Absolutely. You're looking at almost a tank of gas, that 120.
Exactly.
Right.
Nowadays,
Really,
yeah.
when you look at it, that 120 is nothing compared to $15,000.
Right. And when you take into account, yes, the high interest rate is higher. For those of you who fall within a tax bracket where you can write off your interest, savings on your taxes.
Wow. Great question.
That was a really good question. Thank you, Vonley.
Thank you.
That helped. So the FHLB, I'm going to address a little bit separately because, like I said, it's not always available. Right now, we're only offering it with a conventional loan. So you've got to have higher credit, and you've got to qualify for that with tighter guidelines. But it's $7,500, and it's grant money. It's forgiven after 5 years. It can be tacked on to any loan program. It will take third place. So when we talk about the Maryland Mortgage Program, your first mortgage, the bulk of the money that you're buying at 6.125 sits out there. That's in first place. That second mortgage of $15,000 with no interest, free money, is in second place. And then the FHLB will step in and give you additional funds if you need it. And it's interest free. It's a grant that goes away in 5 years. So if you stay on the property for 5 years, it doesn't have to be paid back. Okay.
For those people who don't know, can you tell them what the initials stand for?
Oh, that is the Federal Home Loan Bank of Atlanta, and it requires that lenders be partnered with the Federal Home Loan Bank of Atlanta. It's money set aside each year that is allocated to each bank that offers it. We offer it through one of our affiliates. That's why we can only offer it through the conventional product, because they only offer a conventional loan, but they will allow us to tack it on.
Awesome. Now, what about credit?
Oh, wait.
score? Oh, sorry.
That one also has really low income limits compared to other loan programs. So it's a smaller percentage of people that will qualify for it.
Okay. What about when people are considering purchasing a house and they're doing Credit Karma for their credit scores? So when you look at Credit Karma and it says I'm a 680, 700, but then when you run it, you're a 585.
Okay, so yeah, that happens a lot. It's a conversation that I have to have. I actually researched this because I use Credit Karma to monitor my credit.
Mhm.
All right, Credit Karma is a great tool for monitoring your credit on the consumer side. Keep in mind that there are several different scoring models out there. And if we specifically address Credit Karma, they use a Vantage score. It is geared specifically for consumer credit cards, installment debt, etc., not mortgages. And I actually just had this conversation too with somebody this morning about in my household that he said, how do I monitor my credit? I said, you use Credit Karma. He goes, will it tell me what your credit score reading is? And I said, no, it will not. Generally speaking, if your credit score is 720, we can expect to pull somewhere around 680 on ours. We're pulling a FACTA, a FICO, and a Fair Isaac score. We're pulling 3 repositories. Credit Karma monitors 2, but you want to pay special attention to a FICO score versus a Vantage score or something to that matter. And then within the FICO scoring model, there's like 8 different scoring models that they use. So the best thing is that understand, first of all, we're going to pull something different. We may. If you've never had a late payment, if you're utilizing very small percentages of your credit card debt, and you don't have collections, judgments, or anything sitting out there, then the scores should be more similar, but they're not going to be the same. And in fact, Credit Karma has a lovely disclaimer right on their app that I had found that states exactly that. We're using a Vantage score. You may not get the same one through your bank. But it is a perfect tool to see things that are happening on your credit. You will know if your credit score moves. You'll see positive and negative movement. You'll see if there are inquiries that you have to monitor because you didn't put them on there. But those kind of things are important, I think, in general, when you're preparing to buy a house, is actually to get one of those tools. Now, your credit cards and your bank or credit card companies and banks also have scoring models, but you're not ever going to get all 3 compiled into one report. Annually, you can pull a free credit report. It's annualcreditreport.com, I believe is the website. But you can pull 1 free credit report each year, and I highly recommend that you do so. And if you ever have questions on it, send us a copy. We'll review it with you and see what things might be hot spots, you know.
Oh, go ahead.
Go ahead.
So is there, like Experian, is there a site that someone can go to that gives them a closer score, or is it from their credit cards, something that's going to give a better idea than Credit Karma?
You can actually go out to each of the repositories and pull an actual credit score, and they will say mortgage. And if you click on that, it'll tell you what that is. So I know credit wise through Capital One, if I wanted to go, if I was testing it out, I could actually choose to go, and if I was applying for debt, I could choose mortgage and it would send me out there. So like when you go to buy a car, they may only pull Equifax. Equifax doesn't show up on Credit Karma. It's TransUnion and Experian.
Okay.
So, and even sometimes when people have their car, they go and buy a car before they come to see me. Not a good idea. So they'll come to me and say, oh, it's different than what I had through Equifax. What is your Equifax score show? And I'm like, well, it's this. And they're like, well, why is it different? I'm like, well, probably because I see 20 inquiries from that car loan because they were shopping that car loan. So I will point this out too. Okay, let's talk about inquiries, because that's another thing that I get.
Yeah.
When you're applying for a mortgage, you have a 30 to 45 day window to have your credit pulled multiple times by a mortgage lender.
I'm sorry, you said 35 days?
30 to 45 days.
Oh, okay.
I like the 30-day window. That I'm told it's 45 days, but I get the heebie-jeebies when I go out. So I give myself a little buffer there. So within 30 days, if you're shopping for a mortgage and you want to talk to different lenders, hopefully you'll like to talk to me. But anyway, if you're talking different lenders, you can have your credit report multiple times. Now, in that time frame, depending on when your creditors report to the repositories, if there is a reporting that occurs between day 1 and day 16, and you have your credit pulled on the first day and the 16th day, there can be a change because of different things being reported on your credit, but you are not hit because of the credit pool. You don't have points deducted due to the credit pool. So if I pulled credit on the 1st and everything looked really good, and then your American Express card had not reported yet, and on the 16th reported a late payment last month, that will change it. But my credit pool within that 15 days would not matter. Make sense?
Okay.
Now, if you go and you apply for a car, and then you apply for a credit card, and then apply for a mortgage, that's 3 hard hits. But you can go mortgage within a 30-day period and only receive 1 hard hit. Now, car companies love to shop your car loan, and they'll go to different banks. Each bank will pull your credit. Each one is a hard hit because they're not necessarily associated with what you're shopping for, where mortgage credit reporting is. Make sense?
Mhm.
Makes sense.
Yeah, and I mean,
So it
right
looks
now,
like- I'm sorry, it looks like, Erin, that Alice and Joseph may have a question. I see that their hand is raised. You want to ask your question?
Are you unmuted so they can?
It looks like they're unmuted. So can you guys, do you want to, or if you want to use the chat, if we can't hear you through the technology that you're using, you can always go in the chat and type the question in the chat. I saw that you had your hand raised. We just don't want to miss you. Okay. So hopefully if you have a question, feel free. And also, I think it was Crystal that was on the iPhone, correct? I think Crystal.
It's Priscilla.
Priscilla, so sorry, Priscilla. Priscilla, so sorry, Priscilla. Priscilla, Ashley, if you have questions, feel free to unmute your lines to ask questions or put them in the chat. So if you're comfortable putting this in the chat, we want to make sure that we answer your questions as well. I just saw that the hand was up, so it might have been an accident, I don't know, but still feel free to ask questions.
Okay.
Ashley said thumbs up.
Ashley understands the technology. Cool. All right, Ashley. All right, so my apologies. I just want to make sure that we didn't miss anyone there with questions. So that was some great information. My apologies, Erin.
Oh, no problem. I can talk about all kinds of stuff all the time. Once you get me going, I can't stop.
Well, quick question, student loans.
Mhm.
So how are those, because a lot of people have them in forbearance. I've never had one, so I don't know the different ramifications of it. I know some affect you, some don't. I have a girlfriend who has over 100,000 in student loans. I have no idea how she's going to ever buy a house because of that.
There are ways. Well, student loans are not treated equally through the loan programs. Some of them are, so first, if you're in forbearance, if you are in a deferment for student loans, when applying for a mortgage, we are required to utilize some sort of debt that accounts for those student loans. Okay. It used to be if they were deferred for 12 months, we don't have to use them. Or if they were in forbearance for 12 months, we don't have to use them. Now we're required to count a payment. So under an FHA loan, under certain conventional loans and under USDA loans, we have to use 0.5% of the balance as a payment and put it in there. Now there are caveats. There are 2 types of conventional loans. One says you have to use 1% or half, and the other says 0.5%. So depending on the automated underwriting system that's used to determine the risk of your loan, we can use either 1% or 0.5%. Now, on one of those conventional loans, if you're on a fixed payment, or if a payment shows on your credit report, and even if it's an income-based repayment, we can count whatever that payment is. And those are conversations we have with the borrowers. So your friend with $100,000 may only make a $500 payment, and it might be a 40-year loan, and it might be income based. But if that's what that payment says is on the credit report, we know to utilize that particular conventional product and run it through that way.
Oh, okay. Okay. So it's more about the payment than the balance.
Correct. It's more about the payment because remember that when the crap hit the fan back in 08 and 09, and we had all this mortgage stuff going on, the ability to repay your mortgage is the one thing that we have to make sure, and those debts are considered in that ability to repay.
Okay.
That was like that is our one rule. Must be able to repay that mortgage now and in the future.
Perfect.
So, so VA is a little different. If we have anybody that is a veteran, just so you know, they will allow loans that are in forbearance to be, they take the total balance, multiply it by 0.5% and divide it by 12. So it's very generous with what needs to be counted.
Okay.
So, but yep, that's, and the Maryland Mortgage Program follows whatever guidelines that main loan does. So if they say you have, you're using an FHA loan, we follow FHA guidelines. If you're using a USDA loan, we follow USDA guidelines. If it's conventional, we follow US conventional.
Can you talk to us more about USDA loans? I guess it's not quite understood what areas qualify for USDA and certain parameters. So if you could break that down for us.
Absolutely. So USDA, the history of USDA, no, just kidding. We used to call it the farmer's home loan. It is designated to what would be considered rural areas. Now, most of us would not classify La Plata, which is where my office is, as rural. But guess what? All of La Plata qualifies as long as it's not down that 488 corridor, which backs right up to St. Charles in Waldorf. For those of you that are familiar with the area, I'm not sure Allison, Joseph, Ashley, or Priscilla, if you guys are familiar with these areas, but essentially it is designated area. You have to live within you have to be buying a house that is designated a USDA eligible area. There's a website. We go out, pull up the property address, see if it's qualified. If it's qualified, then we go there. It has an income limit. They just recently increased the income limits for a family of 1 to 4. If you make less than $129,400, you can qualify for a USDA loan. That housing expense ratio is kind of their one rule. They don't want you to exceed a certain percentage, and they have an automated system that must be used. And if it doesn't go through the automated underwriting system, it will not accept it. We cannot proceed. What?
The interesting thing about USDA is, although it's classified as rural, you would be surprised at some of the areas that USDA does allow. Like there's a part off of 228 that's that is a nice housing development, and they consider that rural because at one time it was just a farmland or woods. There's places of 301 on the Marlton that were considered USDA. So people are really surprised to find out that the USDA area actually has a wide range, and it's just not like farm area.
Correct. Most people think you have to buy in the middle of the Midwest. Well, you don't. You can buy in Charles County, St. Mary's County, Calvert County, and even in PG
Prince
County.
George's, like Upper Marlboro, certain parts of Upper Marlboro, I think, are also considered USDA qualified.
Right. So the Upper Marlboro, as you drive down, I guess it's 5 there, and you go into Upper Marlboro, Marlton is on that right-hand side.
Yeah.
Everything on that right-hand side is eligible. On the left-hand side, it's not.
Isn't that weird?
I know.
Same about 228.
Same about 228.
On the right side.
Yep. Well, and as you go south in Waldorf, in that Forest Park area, everybody know where Nix of Clinton is?
Yes.
Okay, you go past that road, and as you go down, everything on the left is eligible and nothing on the right. They used to actually say if the house was a certain number of yards off of this road, it was not or was eligible. They've got a lot, they made it a lot easier.
Got it.
So-
We also have a question in the chat by Alice, and she wants to know how many working experience years must someone have before they can buy a home?
Very good question. Actually, so loans say we have to document a 2-year work history, okay? But if you have 1-year work history with no gaps of employment and you were in school prior, we can use that. As long as we can keep in mind that our job is to, yes, read the guidelines, know what the guidelines say and conform to those guidelines. There's always exceptions or things that we can put together that make sense. If you're an hourly employee and you have less than 6 months of employment, you're going to need to wait 12 months because we have to have something to be able to average your income with, because on an hourly employee, we have an average. If you're a salaried employee, you're guaranteed you're going to make this much money every month. That might be a different story for somebody who might have 6 months. The key is you want to watch for employment gaps. We want to be able to document a 2-year work history, and education counts towards that work history. If you've been in school, we just get tax transcripts. Okay. So it's not like a permanent rule. So it's a case-by-case basis, and it's for us to put together the story for the underwriter to have them make sense to sign off on the income we're using to qualify you.
Now,
If that
I want you, Alice fell off and now she's back on.
Okay.
So could you just like repeat that again for her? Because she kind of fell off when you were answering that question.
Yep. So most loan programs say that we have to have a 2-year work history. However, there are exceptions to that based on your particular situation. If you're an hourly employee, then we're going to want to be able to average your income. They usually want at least 12 months on the job in order to do that. The main thing is you want to avoid gaps in employment greater than 30 days. We want to be able to explain it. So our job is to know the guidelines, understand the guidelines, interpret the guidelines, and then apply it towards your situation. And everybody's situation is different. So if you're self-employed, 2 years, must have 2 years. Okay. Now, there are exceptions to that too, depending on how much money you're putting down, what your credit scores are, and how long you've been in a specific business. So it's not, we look for that 2-year history, but you don't necessarily have to have it, and it's on a case-by-case basis. It is totally part of the entire picture of your loan. So I would say if you have at least 6 months, you're a salaried employee, we could probably get something done.
What about a part-time job? Oh, I'm sorry, Janell.
Go ahead.
Part-time.
What about part-time?
You've got to have continuous part-time employment for 2 years in order to use the part-time job.
Okay.
Okay, so if you have a primary job and then you're working as a waitress on the weekends and you have a 2-year history, we can use that income. But if you don't have a 2-year history, we cannot.
Okay, so I'm not sure. The second part of the question was, is it possible to buy a house without a down payment? And I think basically that's where some of the programs will come in to assist with the part of the down payment that the buyer may not have.
Absolutely. So the Maryland Mortgage Program gives you $5,000, 3%, 4%, or 5% to apply towards down payment assistance. The USDA loan is a true 100% financing program, meaning that it does not have a down payment requirement. And if the house appraises, you can finance closing. So yes, it is possible. It just may mean that you have to qualify either for the Maryland Mortgage Program or buy in a rural area.
Next question deals with, okay, so once you find the home, are they able to contact you and get an estimate of approximately how much the mortgage payment will be so they can make an informed decision on if this is the right house for them?
Yes. So my suggestion first and foremost is to get pre-qualified. Give us your paperwork, let us take a look at it, have it all ready. So we know where you have to fall into. When you're out there shopping, by all means, send us properties. We'll run numbers all day long to show you what those payments look like and what your cash for closing would be based on all of the programs that you qualify for.
I believe Priscilla has a question.
Okay?
Priscilla?
I wanted to know, I've been on my job, next month will be 12 years. If I was in the process of trying to look for another job, do you suggest I stay there until my home process is finished, or is it okay to transition into a new job?
Okay, don't quit your job while you're in process. Okay, so once you find the property, do not quit your job. Okay, but if you're transitioning to a similar position and a higher rate of pay, and you're either transitioning from an hourly rate of pay to a salary rate of pay, that is okay. But if you're going hourly rate of pay, different form of work, different hourly rate, that would be really risky.
Okay.
You've been on your job for 12 years. If you are a salaried employee and you're changing positions with another company, but you're doing the same similar work and you're going salary to salary, you're okay. We just have to make sure that we have a start date and offer letter, and you have to have a pay stub before you go to closing.
Okay, and I had one more question. As far as the USDA loan, what do your credit need to be, the credit score?
So
So get approved.
technically they say their minimum credit score is 620. I will be honest with you. They have gone to this automated system. They do not allow a manual underwrite. The automated system, I have not seen them take anything lower than a 640.
Okay.
Okay. And sometimes we'll get a rejection from that automated system, and that rejection would be because of credit. So we want to look at it. Now look, there also, when you come to us, the other thing that we're going to be trying to do is find ways to increase your credit score. There may be small tweaks on your credit score we can make to bump you up to a 640 within a 30-day period, just by paying down debt or cleaning up a few things here and there. So I would say, if you're concerned about that, you've been monitoring your credit, before you go and do things to your credit, let us look at it and let us help you.
Okay, and is there an annual fee on this loan?
On the USDA loan?
Yes.
Okay, so yes.
Okay.
All right, but okay, so your mortgage on a USDA loan, any loan that you put less than 20% down on, regardless of how it's marketed, has some sort of insurance policy in the form of mortgage insurance, private mortgage insurance, a guaranteed fee that ensures that if you default on the loan, it's going to get paid off, or that the lender will receive some money. Okay. In the case of a USDA loan, when you go to settlement, there is a 1% fee that is financed into your loan, which is the upfront guarantee fee. And then monthly you pay it shows as other, but it is a mortgage insurance premium that is used to pay the annual fee at the end of the year.
Okay.
Okay, so it's not a separate cost for you. It's included in your mortgage payment. The lender takes care of it. The brilliant thing about the USDA loan is, even though that money is going to be there and you pay on it for 30 years because you're borrowing that type of loan, it decreases over time as you pay down the balance.
Okay.
Okay, where if you take out an FHA loan, they charge an upfront mortgage insurance premium of 1.75%. It is financed into the loan, and you pay a monthly mortgage insurance premium that is higher than what you pay on that USDA loan. And it is for the next 30 years unless you refinance.
Okay. And then I have one more question. If I use Navy Federal,
Yep.
is it true that if you use the credit union that you don't use that they don't charge a insurance monthly?
They do not charge a monthly insurance, but if you're talking about the home buyer's choice loan,
Yes.
their interest rates are much higher.
Okay.
And if you're buying in an area that's USDA loan, a USDA eligible, I would recommend that over the home buyer's choice. They charge a premium upfront for that loan. You'll end up coming out of pocket with more money in the long run, and you'll end up paying more.
Okay. Thank you.
You're welcome.
I do want to hit back.
Great questions, Priscilla.
Very
Yes.
good. I want to hit back on, we were talking about the credit, and what I want to hit on is where it's best to have the lender look at your credit, because sometimes we think that we may be making choices and paying things off on our credit that is not advantageous to us.
Correct.
For example, we could be seeing something that's on our credit that's not even reporting on our credit anymore, but yet we go and we start paying on it. And now what we've done is reactivated it. So now it's now going back to showing that you're delinquent in all these payments. So it's best to make sure that we contact the lender so that the lender can make a determination on what is the best course of action and what needs to be paid and what we need to maybe not touch right now.
Absolutely, because sometimes paying off the wrong debt is the worst thing you can do to your credit score. So, and look, it's hard. It's hard to make that call knowing that you might have lower than average credit scores. And I know it's difficult to do that. However, we've seen it all. And we have tools that will allow us to make determinations on your credit. We can look at which things will help be paid off. Sometimes it's time, and as time passes, but we have tools that we use in order to determine. Number one, if we pay this, this, and this, will our score go up? And then if we do it right now and we're not getting the immediate response, do we have to wait 30, 60, 90 days, sometimes longer, in order to get that score up? So that's what we do. Our goal ultimately is to get you into a home. And this is a free service. Now, I'm not a credit repair expert. I can't go have things removed. I can give you information on how to get them done yourself without having to pay somebody to do it. I cannot stand when somebody comes to me and says, we've been working with a credit repair, and I go out there and everything's been disputed, but nothing has been removed. The disputes automatically take those out of your credit score. But before I close on a loan, I have to remove the dispute. So all the work that's been done and you've paid monthly $50, $75 to have somebody dispute, I have to undo it. So the first thing I'll do if somebody comes to me and says, oh, we did this credit repair, my credit scores have gone up. I'm like, great, you now have a 650 score, but I have to remove all these disputes. And when I do that, your score drops back down to 619. So that's doing the wrong things can be hugely detrimental to your future mortgage. And that's why the best thing is really, if you're exploring all of those options and that is your goal, is let us take a look at it. Let us run it through our simulators and let us determine what the best route is for you. Now, I'll say charge-offs. Some people have charge-offs, a car that they might have had, given back at one point, or even sometimes rentals that the lender has essentially charged it off and says, we're not going to pursue it, but we're just going to let it sit out here on your credit report for the next 10 years. We don't worry about that. And I don't necessarily recommend going to take care of it unless that's the only thing we can do. Okay. I look first and foremost, do you have an open and active credit card for at least 12 months? That's first thing. If you don't, that would be one of the first things I tell you to do, because as we're cleaning up this, we want to be establishing. Then I look at your credit balances. Okay. If you are maxing out credit cards, we're going to start knocking down those balances. The rule for credit cards is 30%. If you are financing less than 30% of whatever your maximum limit is, your credit should maintain. 10% for building. So if I have $100 line, I don't want to spend more than $10 on that card every month or carry a balance over of more than $10. Make sense? Okay, so that's the second thing. We look at paying things down. As a last resort, I look at paying off debt. Okay, because if you don't have any open and active credit, all you have is a charge off and a collection. The minute you clear that charge off and that collection with no open, your scores are going to go away or get worse. So it's not as easy as just going in and paying everything off.
Okay, so I have one quick last question as we kind of get down to, I guess, the last 6 minutes or so.
Wow.
Yeah, it goes fast,
That
right?
was fast. Yeah, it did.
So let's say if I have a really kind uncle, like my Uncle Carrie, who wants to give me $10,000 towards, my closing costs.
Yep.
When am I supposed to report that? Like, how am I supposed to report those funds? Or make you aware that I have this 10 grand from my awesome Uncle Carrie.
Yep. Say he's going to give us $10,000. Okay, great. We're going to document that as a gift. Okay, very generous. We love generous uncles, aunts, grandmothers. We love that. Okay, but we have to properly document it. Now, he may not want to show us some of his bank accounts, because so the mortgage industry hates cash. We have to know where all that money is coming from. So essentially, we're going to ask for a gift letter. And he's going to have to be willing to sign a gift letter saying he's giving those funds. We will ask for one of his bank statements showing he has the funds to give.
Okay.
And then depending on whether or not he gives it to you prior to settlement or at settlement, we're going to tell you how to transfer those funds to you. Okay. Now, my preference always is if I know ahead of time that he's going to be giving a gift, I get the gift letter, a copy of his bank statement, and then I'm going to have him send that money directly to the title company and not have to get any more documentation. Okay.
Gotcha.
If he sends it to you prior to, then we're going to have to show the funds coming out of his account, deposit into your account, and then your balance on your current bank statement showing you have the funds available. So it's an extra step, but we can definitely deal with that. The main thing is when you go into a mortgage and you're talking with your loan officer, we want to know everything about your financial picture. Remember, I'm not an underwriter. My job is to present this beautiful story about how you're going to repay your mortgage and you've got this money to go to settlement, and present it to an underwriter in the best light possible. We're your defender. We're your storyteller. And the underwriters, I saw a meme the other day. It was really funny. I'm going to become a professional wrestler, and I'm going to name myself the most scary thing to mankind, the underwriter. Okay. This mysterious being over here that can make or break our lives. So,
Exactly.
so she's my professor. I'm trying to get an A on your paper. My paper is your loan, and I need an approval or an A. So essentially that's what we're doing so don't be afraid to tell us stuff. Okay. I might go, oh my God, why? But I'm still going to be okay. And my goal is to get your loan closed, to get you into a house, and if not, it's all for naught. We've spent a great deal of time together, and I'm like, okay, no. But yeah, you talk to us about that. Tell us you're getting that gift from your generous uncle, tell us you have something that isn't on your credit report right now, so I know to deal with it. If you have tax liens, tax payments, this is something that has come up a lot lately, because keep in mind, everybody just did their taxes. They may have owed money. They haven't necessarily told us, Eric, haven't necessarily told us that they have a repayment plan with the IRS. We need to know that, because there are rules that govern that as well.
That's a good point. I'm glad you brought that up.
Yeah. I mean,
We're
we're down.
We're down to the last 2 minutes, and I want to make sure that if there's anyone that's joining us and have questions, that they can ask their questions, or they can put it in the chat right quick, because we want to make sure that, that you came on this, and wherever, for whatever reasons you want to join us, that we've actually addressed the issues that you want to. Erin, make sure that you give your contact information. And also I'd like for you to tell them the documents and things that you would need should they want to move forward.
Absolutely. Doesn't look like I can chat right here, but I will send it to you, Janell, and if you want to share it with everybody. And probably the best thing is just to go ahead and email me, and I'll send you everything personally.
Okay. So do we have any questions from those who are joining us today? All I see everybody is muted. There's no questions. Erin, we want to thank you for
Thank you.
the opportunity to presenting. Like I said, we kind of start on time and we end on time because we do know it's a Saturday and people have lots of things to do. We're going to make sure that everybody who has joined us, we will reach out to you via email to make sure that you have all the information for our group, for Erin's group, so that if you'd like to go forward or you'd just like to find out what's needed or what's necessary in order to go forward. But Erin, right quick,
Yes.
the documents that you would need for them to start collecting.
W-2s for the last 2 years, tax returns, just federal for the last 2 years, bank statements for the last 2 months, pay statements for the last 30 days.
Fantastic.
And
Tia, take it away.
All right, good people. Well, thank you so much for joining us. Priscilla, I appreciate you. Alice, Joseph, Ashley, we're so grateful that you joined us this morning. We're doing this again next month, July 9th, I believe, at the same time. So we try to be consistent with the time in which we offer them. And I believe we'll also have a home inspector on that session as well. So if you have questions or want to come back and join us, feel free. You can come back as many times as you want. Bring friends. I hope you guys have a great rest of your weekend. And again, you'll be getting some information from us shortly, just to kind of help you along that home buying process. And we're always here to answer any questions that you may have. So once again, thank you so much and have a good rest of your weekend, folks. Thank you so much. Thank you, Erin.
thank you guys.
Thank you.
Talk to you
All right,
soon.
have a good one.
Thank you.
Bye.
Bye.